Is the AI bubble bursting? Big short investor bets billions against Nvidia. US markets just faced a Black Tuesday. Was the AI bubble finally starting to pop? Making matters worse, the legendary hedge fund manager who famously bet against the US housing market before the 2008 crisis has now allocated roughly 80% of his fund's portfolio to shorting Nvidia and other AI companies like Palantir. If this is indeed a bubble and it bursts, US stocks could relive the dot-com crash of 2000, with indices facing a devastating knee-jerk collapse. The question is, how severely would this impact China's A-share market? The Black Tuesday trigger. Yesterday, US capital markets experienced a strange and sharp sell-off. The company blamed for leading the decline was Palantir, a firm often described as an arms dealer for data, which provides high-end data analysis systems to the US government, military, and major corporations. It is a quintessential AI application company. The confusing part? Its newly released Q3 earnings report was stellar. Revenue hit $1.18 billion, up 63% year-over-year. Q4 revenue guidance was raised to $1.33 billion, significantly above the analyst consensus of under $1.2 billion. It recently secured a $10 billion, 10-year military contract. It also just formed a joint venture with a company in Dubai. With so much good news, you'd expect investors to be buying. Instead, they sold on the news, driving the stock down nearly 8% and dragging the broader market down with it. The big short is back. The key figure behind the sell-off is Michael Burry, the man who predicted the subprime mortgage crisis. According to his fund's disclosures, he has placed about 80% of his portfolio in short positions against Nvidia and Palantir, with a total value of these bearish bets reaching approximately $1 billion. He is going all in, trying to trigger a collapse of the leading AI companies. He has also been actively warning on social media that an AI bubble is imminent and that many tech stock prices have completely detached from reality. In response, the CEO of Palantir publicly lashed out, asking if Burry had lost his mind for shorting two such excellent companies. But those familiar with Burry's story know that when he shorted the US housing market, everyone thought he was crazy. Wall Street peers mocked him for using a telescope to see risks that required a microscope. Yet he held his ground under immense pressure, ultimately netting $750 million personally and delivering a 489% return for his fund. His story was later immortalized in the Oscar-winning film The Big Short. Now he's using the same playbook, and this time, no one is quick to write him off as a madman. Burry's rationale: the numbers don't lie. His argument holds water. Palantir's PE ratio is a staggering 439. Even an industry titan like Nvidia has seen its PE ratio soar to 57. This means that if Palantir fails to maintain its current exponential growth, investors who buy and hold today might have to wait over a century to see a return on their investment, by which time the company would likely be long gone. The market has priced in decades of future growth, creating a terrifying level of overvaluation. What's even more alarming is the circular ordering game being played by US tech giants in the AI space. Nvidia invests $100 billion in OpenAI. OpenAI turns around and places a $300 billion, 5-year cloud services order with Oracle. Oracle then places tens of billions of dollars in GPU orders with Nvidia. This cycle artificially inflates the revenues of Oracle and Nvidia, leading to soaring stock prices. The problem? Total investment in AI by US tech companies has reached the trillions of dollars. If this fails to generate substantial real-world returns, it will inevitably form a bubble, and all bubbles eventually burst. Wall Street's growing chorus of concern. Burry isn't alone. Several Wall Street executives have now voiced concerns, warning that US stock valuations are too high and predicting a potential 10 to 20% market correction within the next year or two. Much of this overvaluation is directly fueled by the AI frenzy. One might ask, don't the executives of these AI giants see the bubble? Why are they still diving in headfirst? The answer is simple: they have no choice. If any major tech company announced it was halting or reducing its AI investments, it would be immediately abandoned by investors, its stock would crash, and its executives would likely lose their lucrative jobs. So, they're forced to play the game of circular investment and mutual contracts, hoping for a miracle. The potential fallout for US and Chinese markets. If the AI bubble does pop, the impact on US markets could be catastrophic. Consider this. The combined market capitalization of the Magnificent Seven, Nvidia, Microsoft, Apple, Google, Amazon, Meta, Tesla, has reached $22.2 trillion. The total market cap of the entire US stock market is $44.9 trillion. This means these 7 companies alone account for nearly half of the entire market. Since AI is the top-level strategy for most of them, and considering the semiconductor and robotics sectors tied to AI, a burst bubble could truly replay the tragedy of the 2000 dot-com crash. What about China's A-share market? The impact on China's A-share market would likely be far more limited. While AI is a hot topic, most so-called AI concept stocks in the A-share market don't actually rely on AI for their core business. Many genuine Chinese AI giants are either not listed or not listed in the A-share market. From a sector weight perspective, traditional manufacturing leads at 22%. Financials follow at 19%. The electronics sector, which has some AI overlap, accounts for only 11%, and more than half of that is tied to Apple and Huawei supply chains for phones and tablets. Therefore, even if the AI bubble bursts, the direct impact on the A-share market would be relatively contained. The bottom line: a true AI bubble burst would deliver a significant psychological blow to the fragile global economy. With growth already sluggish, many are pinning their hopes on AI to drive a new technological revolution and boost productivity. If those hopes are dashed, the disappointment could ripple far beyond Wall Street.